9 out of 10 traders fail. They don't drain their accounts because their technical strategies are broken. They lose capital because they walk blindly into an unmapped minefield, hoping to survive on raw instinct alone. To navigate this environment, you need a specific set of instructions. Jason Allen Jankowski lays out 25 psychological rules in Trading Rules That Work. These rules don't tell you what to buy, they tell you how to think. Adopting these 25 principles transforms trading into a precise art form. Ignore them, and you guarantee your place as just another victim feeding the market's bottom line. You have to define exactly why you are opening your broker app. If you're here to gamble, feel adrenaline, or seek revenge on a boss, the market will drain your capital immediately. Survival requires a baseline of cold professional execution. Without that baseline, you fall into the reaction machine trap. A single green candle flashes, and you buy. A negative tweet goes viral, and you panic sell. The market constantly generates noise specifically designed to force you into making knee-jerk, emotional errors. This diagram outlines the anatomy of professional execution. Every single trade requires a strict 3-part plan. You must know the exact logic for your entry node, the defined limit of your financial risk below, and the specific target for your exit above. If you cannot articulate that plan before you click a button, you cannot generate consistent profit. In a hostile environment, choosing not to trade is frequently the most professional execution possible. Your body will warn you when you break your rules. If your palms start sweating, your chest tightens, or your heart races watching a chart, your biological silent alarm is ringing. That physical response is panic, not trading intuition. Those physical reactions often trigger the boredom trap. You sit at your desk, stare at a flat market, and take an uncalculated filler trade purely to feel productive. Those unnecessary trades slowly bleed your portfolio dry. When those filler trades go bad, human ego prevents you from cutting them. You hold on, hoping the price will reverse, turning a minor error into a massive wound. You have to accept a harsh reality of the business. Your first loss is your best loss. Taking a small early loss isn't a failure. Walking away from a setup that confuses you isn't a retreat. Those decisions are active survival mechanisms that keep your capital intact for tomorrow. Here is the psychological twist most traders never figure out. The market is not out to get you. It is a completely indifferent mechanism. It doesn't know you exist, and it certainly doesn't care about your account balance. The fear that paralyzes you and the greed that makes you hold a position too long do not originate on the charts. They are entirely manufactured inside your own head. The market acts as a fragmented mirror. It simply reflects your lack of discipline, your impatience, and your internal psychological flaws back at you in the form of red numbers. You can buy the most expensive charting software in the world, but no technical indicator will save you if you are emotionally compromised. Self-mastery is the absolute prerequisite to profitability. Mastering your emotions allows you to deploy defensive tactics. The most effective defense is realizing that holding cash is an active position. Sitting patiently on the sidelines requires massive discipline. Extracting capital from a move is an art form, but defending that capital is a strict science. You lock in your gains mathematically. You use trailing stops to secure profits instead of watching a green screen turn red because you held out for one more tick. This control panel visualization represents the 3 deadly questions you must clear before execution. What is my absolute maximum loss? What is the specific logic for entry? Where exactly is my exit? If you hesitate on even a single answer, the entire board locks down. You must keep your hands completely off the keyboard. This rigid structure forces you to treat every trade as a cold business transaction. You execute the numbers, you take the result, and you move on. You do not marry a trade, and you do not let it dictate your self-worth. Look at this line chart mapping a trader's capital. You log a year of slow, highly disciplined growth, but a single emotional all-in decision from fear of missing out drops your balance to 0 in an afternoon. That sudden drop frequently leads to revenge trading, doubling down to win back what you lost. Or worse, you start following the blind advice of online gurus who won't reimburse you when their tips destroy your account. Financial losses are mathematically inevitable in this profession. You have to reframe them. A loss is simply tuition paid directly to the market in exchange for identifying a critical flaw in your strategy. Your objective is long-term survival. Paying that market tuition only becomes a waste of your capital if you refuse to study the mistake and learn the lesson. Survival ultimately relies on the rule that simplicity is sophistication. You do not need 15 overlapping indicators cluttering your screen to find an edge. You need clear vision and clinical execution. You also have to cut out the external noise. By the time a headline reaches the front page of the financial news, institutional players have already moved the market and taken their profits. Trading is a grueling marathon. The operators who rely on short bursts of high intensity burn out quickly. The operators who rely on cold, calculated consistency cross the finish line. Look back at these 25 rules. Which ones are you actively breaking right now? Be honest with yourself and write them down in the comments below. Every rule we've discussed relies on your ability to admit when you've broken them. That habit of radical honesty is what allows the top performers to protect their capital while everyone else is busy protecting their ego. Stick to the map, and I'll see you in the next one.